It began quietly, too quietly for what it would soon become. By the middle of the day, the country's financial system was showing signs of strain that could no longer be described as technical. According to data circulating among monitoring agencies, deposit outflows had reached unprecedented levels across multiple major institutions. Officially, state media reported temporary liquidity adjustments. But by this hour, insiders were already calling it what it was, a run. Across several of the country's largest banks, long lines formed in front of ATMs and branch offices. Screens that once displayed currency rates now flashed maintenance alerts. Customers, holding smartphones and silent frustration, refreshed their banking apps only to see frozen balances and delayed transactions. Routine maintenance, read the official notices. But the timing, simultaneous across multiple institutions, suggested something far more deliberate. According to financial analytics reviewed during the day, withdrawals began to accelerate after a coordinated stream of unofficial reports appeared across social networks, warning of pending restrictions on foreign currency accounts. These claims were promptly denied by regulators, yet the denials only fueled further panic. Liquidity remained sufficient, one official declared, though sources within the central bank privately admitted that emergency funding lines had already been activated. By this point, the scale of outflow had become systemic. In key metropolitan regions, daily cash withdrawals surpassed levels recorded during the 2014 crisis. Analysts monitoring the situation in real time described the movement as massive but disciplined. People were not storming bank halls or shouting, they were simply moving funds, quickly, quietly, digitally. This isn't chaos, one market observer noted. It's precision. The government's first public statement avoided the term crisis entirely. Instead, it referred to public adjustments in liquidity behavior, language that analysts immediately identified as a rhetorical shield. But the fact that the statement was issued at all, outside normal communication cycles, spoke volumes. In the financial world, premature reassurance is itself a signal. Sources familiar with the banking sector reported that several mid-sized lenders had already requested assistance from the State Stabilization Fund. Officially, these requests were categorized as liquidity optimization. Unofficially, they were bailouts in everything but name. This is how collapse starts in managed economies, an economist with knowledge of the situation explained. The numbers don't appear suddenly, they disappear gradually. At the same time, currency volatility surged. The ruble fell sharply on internal trading platforms before transactions were briefly halted to ensure stability. The announcement came with familiar language, temporary measures, preventive adjustment, yet traders recognized the pattern immediately. When markets stop for stability, said one analyst, it usually means stability has already gone. Across the business community, the mood was tense but contained. Corporate treasurers began shifting assets into hard currency accounts abroad, while ordinary citizens queued at ATMs, withdrawing the maximum allowed before system limits reset. Everyone knows the script, remarked a senior banker off record. You act calm, you say nothing, you move everything. Meanwhile, internal communications within the central bank indicated that emergency liquidity injections had been authorized to prevent what officials referred to as transmission effects, the spread of panic from regional to national institutions. In simpler terms, they were buying time. Liquidity, said one insider, is not the issue. It's confidence, and that's already gone. In the analytical community, comparisons to previous crises began to surface, but experts noted a critical difference. This time, the trigger was not external sanctions or geopolitical shocks, it was domestic trust erosion. The danger here, one economist wrote, is that the system is collapsing from belief, not balance sheets. State television maintained composure. Anchors repeated key phrases: the situation is under control, depositors have no cause for concern, the banking system remains resilient. Yet even in their voices, the practiced cadence of calm sounded strained. In the background of their broadcast footage, queues outside branches contradicted every word. According to data collected throughout the day, at least 3 of the country's largest banks temporarily suspended foreign transfers. The official explanation cited technical verification delays. But to financial insiders, the meaning was unmistakable: capital flight had begun. The pressure is internal now, said one report circulating among investment circles. It's not about sanctions. It's about survival. By this point, ordinary citizens had already learned what economists call behavioral sequencing, the instinctive cycle of panic, withdrawal, conversion, and concealment. The same sequence that, once triggered, rarely reverses on its own. Confidence decays faster than money, remarked one foreign analyst. And when the two vanish together, control becomes theater. As the day unfolded, what had begun as rumor was becoming reality. Branches closed early for system updates, online portals slowed, and officials continued to deny what everyone already understood. Liquidity, said one understated bulletin, is being redistributed. But as experts quietly observed, redistribution was not the issue. What was happening now was far deeper, a shift in the invisible contract between power and possession. When citizens begin to treat their banks as risks, not institutions, the state itself begins to lose its economic pulse. In the words of one analyst who chose to remain unnamed, you can't regulate fear. You can only watch it compound. And though official figures had yet to confirm the magnitude, the rhythm of withdrawals, the quiet precision of loss, was already shaping a narrative no policy could reverse. Perhaps it was not the money leaving the banks that defined this day, but the trust that would not return. By this stage, the word stability had lost its meaning. Official channels continued to repeat it, yet the tone had changed, slower, flatter, as if spoken for the sake of ritual. Inside the banking sector, the numbers told a different story. According to data compiled by several monitoring agencies, daily outflows from retail accounts exceeded thresholds established for crisis scenarios. It's not panic, said one analyst in a confidential summary, it's a quiet correction of faith. In several major cities, banks began to restrict large cash withdrawals, introducing what they called temporary operational limits. These limits varied by region, but the pattern was unmistakable. As in previous crises, the language remained bureaucratic, not restriction, but optimization. To the public, it meant the same thing. By this hour, queues outside ATMs had grown longer, their atmosphere subdued but tense. People no longer asked for explanations. They already knew that official denial was part of the process. Sources within the financial sector confirmed that the central bank had issued direct instructions to regional branches to manage perception. The memo, seen by analysts, emphasized that public messaging should prioritize reassurance over data disclosure. It was, in effect, a directive to contain the narrative, not the problem. Once confidence breaks, one senior economist noted, data becomes irrelevant. Foreign exchange counters saw unprecedented demand. According to currency monitoring platforms, the spread between the official and parallel exchange rates widened sharply during the day, a clear sign that the market no longer trusted the state's own price. In expert discussions, this divergence was described as psychological depegging. The population had stopped believing in official valuations, even before they changed. Meanwhile, reports emerged that several mid-tier banks had quietly frozen outgoing international payments. Official explanations cited security verification protocols. Yet multiple business accounts, including state-affiliated enterprises, were unable to process transfers abroad. For a country accustomed to financial management through control, such paralysis represented something deeper, a loss of internal synchronization. By this point, analysts within the Ministry of Finance were circulating internal forecasts under restricted access. The reports described structural stress in liquidity corridors, a euphemism for systemic cash shortages. The proposed remedy was predictable: central liquidity injections, capital controls, and the public announcement of a stabilization plan. But insiders warned that announcing such a plan would be an admission of crisis, and that admission might accelerate the very outcome they were trying to prevent. As a result, the government chose silence, the most familiar and the most dangerous form of response. Official quiet is not calm, one policy observer remarked. It's containment through denial. In the meantime, citizens had already shifted from withdrawal to conversion. Gold, cryptocurrencies, and foreign assets surged in informal trading platforms. In several regions, police units were reportedly deployed to monitor currency irregularities, a phrase that, according to financial insiders, meant tracking peer-to-peer exchanges. When people start trading belief, one analyst said, the currency itself becomes irrelevant. The crisis was no longer purely economic. It had become symbolic, a referendum on credibility. Each withdrawal, each transfer, each act of conversion was a small vote against the system's promise of security. It's not about money, said an economist from an international monitoring institution. It's about exit, the quiet decision to step outside the fiction. Inside the central bank, emergency meetings were held throughout the day. According to information obtained by financial correspondents, discussions focused not on stopping the outflows but on sequencing their impact, deciding which institutions could be allowed to fail quietly to preserve the appearance of order. Controlled failure, one insider called it. We can't stop the leak, but we can choose where the flood is seen. In the markets, trading volume dropped sharply. Officially, exchanges were functioning normally. In practice, most major brokers had frozen activity, citing system instability. Foreign investors withdrew remaining short-term holdings, converting them into offshore assets before restrictions could expand. Analysts tracking capital flows reported that nearly half of all private offshore transfers were initiated through corporate intermediaries linked to domestic elites, a sign that those closest to power were moving first. The information environment grew increasingly fragmented. State television showed calm footage of orderly operations, while independent monitoring networks streamed video of branch closures and armored trucks delivering cash to high-density urban zones. "It's the dual narrative stage," said one communications specialist. When two versions of reality exist side by side, the public no longer believes either. By now, officials stopped denying that liquidity support was underway. Instead, they reframed it. "The state stands ready to ensure systemic resilience," said one ministry spokesperson, without elaborating on what resilience now meant. Within policy circles, that phrase had become a euphemism for backdoor nationalization, the silent absorption of private institutions into state management. At the same time, international reactions began to form. Several rating agencies placed the country's banking sector on watchlist status. Financial media abroad described the situation as a coordinated withdrawal event. The term avoided the word collapse, yet it carried the same gravity. According to one global bank strategist, when confidence leaves faster than cash, it's already too late for capital controls. In domestic discourse, new language began to circulate: cautious, coded, self-protective. Words like adjustment, pause, and stabilization replaced run, freeze, and crisis. But among the public, the meaning was already clear. People no longer listened to what officials said. They watched what they did, and the only visible movement was withdrawal. By the time markets paused again, for maintenance, analysts understood the pattern: denial, restriction, delay. The familiar choreography of crisis. But something fundamental had shifted this time: the tone. The usual confidence, the performative calm, was gone. "You can fake control," one foreign correspondent remarked, "but you can't fake its rhythm." As the day continued, it became evident that this was no temporary disruption. It was a structural unraveling, not of the financial system alone, but of the narrative that sustained it. And while the screen still displayed numbers, few believed they meant anything anymore. Because once a currency stops being trusted, what remains is not economics, it's theater performed to an audience that has already left. Perhaps that's why, as one insider quietly admitted, the numbers no longer matter, only who still pretends they do. By this stage, the language of control had thinned to near transparency. Every official statement sounded rehearsed, every denial prescripted. The deeper truth was that no one in the financial system truly knew where the bottom lay. The withdrawals had slowed only because there was little left to withdraw. Analysts following intraday liquidity movements reported that several mid-tier institutions had quietly entered what internal memoranda called passive stabilization mode, a technical phrase meaning they were insolvent but not yet declared so. Inside the central bank, sources described the atmosphere as suspended panic. No one raised their voice, but the silence itself was heavy. Emergency liquidity operations continued under the cover of routine settlements. Publicly, the narrative remained consistent: the system is adjusting. But to those who tracked the signals, the adjustment was clearly one of survival. "You can stabilize an account," one analyst wrote in a confidential note, "but not belief." Across the country, the signs of a slow disintegration became visible in patterns too consistent to ignore. Branches reduced operating hours, citing maintenance. ATMs stopped dispensing foreign currency altogether. Online portals displayed loading screens that never completed. In some regions, the official banking app switched temporarily to information-only mode, disabling transactions under the guise of technical updates. It was an elegant deception, freezing the panic by freezing access itself. According to data leaked from an internal monitoring dashboard, the state's liquidity injections now exceeded all previous stabilization rounds combined. In ordinary terms, the central bank was printing its way through the crisis. "They're fighting gravity with paperwork," said a senior economist abroad. And paper runs out faster than trust. Meanwhile, independent analysts began piecing together the real picture, a map of what one report called zones of liquidity distortion. It revealed that entire clusters of regional banks were operating without functional reserves, relying solely on delayed credit from state accounts. "They're alive only on screen," an insider explained. "The system is simulating solvency." For ordinary citizens, the information void was filled with rumors. Some whispered that the state would freeze all deposits above a certain threshold. Others circulated unverified screenshots of restructured balances. Each rumor accelerated what officials tried to slow: digital withdrawals and cash conversions. Information is liquidity now, said one financial strategist. Whoever controls the flow controls the panic. At the same time, signs of internal division began to surface. Different ministries issued conflicting instructions to the public. One urged calm, another warned of heightened vigilance against misinformation. According to insiders, the Ministry of Finance had proposed a temporary closure of all private banks to reset public confidence. The central bank opposed it, arguing that such a move would confirm collapse. Between these competing logics, paralysis set in. Internationally, financial networks began to react in silence, not through statements, but through exclusion. Several foreign correspondent banks reportedly suspended settlements with their Russian partners, pending compliance review. Officially, no sanctions had been announced. Unofficially, the country was being ring-fenced. You don't need sanctions, one Western analyst noted. The system is isolating itself. As this isolation deepened, the domestic currency became increasingly disconnected from its market value. Official rates were maintained through administrative decree, but parallel markets told another story, one of steep depreciation and widening spreads. A currency is a story, said an economist familiar with the data. When no one believes the story, the numbers are just decoration. Inside government circles, some advisors reportedly suggested introducing a temporary moratorium on withdrawals. The proposal never appeared publicly, but its circulation alone was enough to leak. Within hours, long queues reappeared at branches that had just reopened. The state's greatest challenge now was not to prevent panic, but to keep it invisible. Containment through delay, read one internal note. Silence as stabilization. Meanwhile, international financial media began to frame the event in sharper terms. The end of confidence, one headline read. Russia's domestic banking system faces coordinated withdrawal shock. But within the country, the press was silent. Broadcasts returned to cultural programming and human interest stories, avoiding all mention of finance. The absence of language, said a communications expert, is now the state's primary defense. Among analysts, comparisons to 1998 circulated cautiously, but this time, the difference was structural. Then, the crisis came from outside. Now, it came from within. This is not a currency collapse, one observer explained. It's a credibility collapse, and those cannot be devalued, only replaced. Reports also indicated growing friction between the central bank and state corporations, several of which refused to repatriate funds from foreign subsidiaries. They're hedging against their own government, said a European risk consultant. It's the financial equivalent of desertion. By this hour, internal communications within the regulator described abnormal synchronization of withdrawal patterns. In other words, the population was acting collectively without coordination, a behavioral cascade that, once started, could not be reversed by decree. No one told them to run, said an analyst. They just knew when to stop waiting. Across the expert community, a quiet realization spread: this was not a typical crisis, and it would not end with recovery. The events unfolding were irreversible, not because of numbers, but because of perception. In economics, trust can be lost slowly or suddenly. In this case, it had evaporated all at once. Within the walls of the central bank, one advisor reportedly summarized it in a single sentence: we are no longer defending the ruble, we are defending the idea that money still exists. Outside, the streets were calm again. But it was the wrong kind of calm, the calm that follows after the damage is done, when the system still breathes but the pulse is gone. And though officials continued to insist that the situation remains under control, few analysts still believed that control was a measurable condition. It had become a performance, one that could only continue until the audience stopped watching. Perhaps that is why, as the day continued, insiders began to whisper a phrase that had not been used publicly in decades: monetary containment. A sterile term, meant to sound technical, but understood by all to mean something else entirely: the quiet collapse of confidence disguised as order. By this point, the crisis had crossed the line from financial instability into systemic dislocation. The mechanisms of control still operated: announcements, liquidity injections, ministerial meetings, but they no longer produced their intended effects. The institutions functioned, yet their influence had hollowed out. The structure remains, one economic observer remarked, but the authority within it is gone. According to multiple reports reviewed by foreign monitoring networks, the state had begun a broad but discreet operation to consolidate the banking system. Officially, it was described as temporary integration under unified oversight. Unofficially, it was nationalization under duress. Mid-sized lenders were quietly absorbed by state-owned giants. In exchange, those giants received emergency access to central reserves. It's an autopsy disguised as reform, one analyst wrote. They're merging losses, not assets. Internally, the central bank issued new instructions restricting cash deliveries to certain regions deemed non-critical. It was a strategic decision: not enough trucks, not enough liquidity, not enough confidence. The priority shifted to maintaining appearances in the capital and select financial hubs, leaving peripheral regions to absorb the silence. Reports from several provinces described empty ATMs and closed branches, framed publicly as scheduled technical updates. People waited, not expecting answers, only hoping the system would resume pretending. In confidential bulletins, senior policymakers began to discuss the concept of informational stabilization, a euphemism for narrative management. The logic was clear: if trust could not be rebuilt through finance, it had to be simulated through communication. State media launched a coordinated campaign portraying the situation as the result of foreign psychological interference, a phrase deliberately chosen for its ambiguity. It implied threat without accountability. The message isn't to convince, said one communications strategist, it's to confuse. The digital environment reflected this shift. Online searches for currency freeze and bank insolvency returned generic error messages. Independent news outlets saw their access throttled under network congestion protocols. Analysts tracking internet activity noted a sharp rise in automated bot traffic, flooding financial forums with identical reassurance phrases. This is a synthetic calm, one cybersecurity specialist observed. They're trying to drown panic in repetition. Meanwhile, the central bank's internal dashboard showed deepening fractures. Liquidity ratios were artificially maintained through constant fund rotation. Capital moved from one state bank to another in cycles of hours, creating the illusion of solvency. It's like moving water between glasses, said one insider. The volume never changes, but the movement looks alive. In the short term, the tactic preserved headlines. In the long term, it accelerated depletion. By this hour, key ministries began clashing over priorities. The Ministry of Finance demanded full capital controls, including the suspension of private foreign accounts. The Ministry of Economy warned that such a move would institutionalize panic. According to sources familiar with the discussions, the final decision was neither acceptance nor refusal, simply delay. The state had entered a phase of governance by hesitation. They're buying hours, an insider commented. Not days, not outcomes, just hours. Abroad, reactions grew more explicit. Several major investment houses downgraded Russian banking exposure to non-recoverable. The term was carefully chosen, not default, but non-recoverable. It allowed markets to adjust without forcing formal recognition of collapse. In diplomatic circles, the event was described as contained fragmentation, a crisis quarantined within borders, though everyone knew financial contagion obeys no boundaries. In domestic discourse, however, none of this existed. Official statements began to recycle phrases that analysts had heard in previous crises: temporary imbalance, market recalibration, seasonal volatility. Yet behind those words, there was no data, no transparency, only curated silence. We're not seeing reports anymore, said one economist. We're seeing placeholders where reports used to be. Among insiders, a quiet understanding formed: the state would not declare bankruptcy, not officially. It would, instead, manage perception until recognition became irrelevant. A sovereign can't default, one government advisor reportedly said. It can only stop pretending to pay. Outside the offices and press rooms, the real economy began to show strain. Businesses delayed payrolls, retailers stopped accepting card payments, suppliers demanded cash. The flow has reversed, said a logistics analyst. Everyone's collecting, no one's releasing. In systems theory, this moment is called a liquidity lock, when money stops circulating not because it's gone, but because no one trusts its movement. In the capital, the government staged televised meetings to demonstrate continuity. Officials sat behind long tables, exchanging memorized lines about sustainability and strategic resilience. The performance was immaculate: suits, flags, composure, but its rhythm was too perfect, too slow. The tempo of control rehearsed one beat too many. This isn't governance, a foreign correspondent observed, it's theater for the algorithm. And yet, even amid collapse, the machinery of reassurance persisted. New regulations were announced, promising enhanced depositor protection. In reality, these laws formalized what had already occurred: the freezing of withdrawals under the banner of safety. When protection means restriction, said one analyst, the system has reversed polarity. It's defending itself from its citizens. At this stage, the central bank stopped publishing daily financial indicators. The official explanation cited data consolidation for transparency. The irony was deliberate. They've reached the silence phase, noted a senior market strategist. When reporting stops, survival becomes statistical fiction. For the public, the change was subtle but profound. With no numbers to watch, panic became intuitive. People felt instability rather than measured it. It's the invisible stage of crisis, one sociologist explained. When fear no longer needs evidence. In expert discussions, a phrase began to circulate: monetary drift. It described a condition in which a currency still exists legally but loses its social function. The ruble was still printed, still transacted, but no longer trusted. Transactions became acts of compliance, not belief. "They're paying with tokens of obedience," said an economist abroad. And as the system continued its slow-motion unraveling, the question inside policy circles shifted from if to how long. "This isn't collapse in the cinematic sense," one insider remarked. "It's the kind that leaves lights on, for optics." By this point, experts stopped speaking of stabilization altogether. The most optimistic phrase circulating among them was soft paralysis. A condition where the system, unable to move forward or fall apart, simply sustains itself through ritual. But for those watching closely, the rituals were losing their purpose. The statements grew shorter, the tone more forced, the confidence staged. The state was speaking not to calm the public, but to convince itself that it was still listening. And in that echo, the sound of control faded, replaced by something quieter, heavier, and unmistakably final. By this hour, the illusion of recovery had become the only policy left. Screens displayed currency graphs that no longer moved, news anchors repeated the same reassurances in a monotone rhythm, and officials spoke of stability with the conviction of actors reading lines they no longer believed. The numbers meant nothing, the system had entered its final stage, continuity as performance. Inside financial institutions, activity slowed to a mechanical crawl. Transfers were queued but not executed, accounts visible but inaccessible. According to insiders familiar with the situation, the central bank had effectively nationalized the flow of money itself. "There's still movement on the screens," one analyst remarked, "but it's all internal, signals bouncing inside a closed loop." The state, in its attempt to restore order, had sealed the financial ecosystem into self-reference. Transactions existed, but they no longer touched reality. Reports from the remaining independent economists described a phenomenon they called administrative liquidity, money circulating only where permission allowed it, each transaction requiring political validation. "This is no longer a market," one report concluded, "it's a nervous system that fires impulses without consciousness." Meanwhile, for ordinary citizens, the collapse had taken on a different form: quiet normalization. The queues had disappeared, not because confidence had returned, but because exhaustion had replaced it. People no longer waited outside banks, they had accepted that what was locked inside would not return. "When panic ends without resolution," said a sociologist interviewed anonymously, "what follows isn't calm. It's adaptation." In this adaptation, a new order began to emerge, informal, improvised, and invisible. Across regions, barter networks resurfaced, payments were made in goods, labor, or foreign currency exchanged privately. "It's not rebellion," noted one analyst, "it's substitution." The state still claimed monopoly over the ruble, but society had quietly invented an alternative economy beneath it, fluid, decentralized, beyond supervision. According to internal documents reviewed by several monitoring agencies, government strategists had identified this trend and classified it as temporary informalization. Yet the tone of their language betrayed unease. In practice, temporary was becoming permanent. "When people stop needing your currency," one former official wrote, "they stop needing your authority." Internationally, attention had shifted. Financial observers no longer spoke of Russia's crisis, but of its decoupling. The term carried an artificial neutrality, but the meaning was clear: isolation had hardened into condition. Global markets adjusted quietly, absorbing losses, recalibrating exposure, moving on. The collapse had been contained geographically, but psychologically, it had transcended borders. Analysts described it as a living exhibit of systemic exhaustion. Inside the central bank, the rhythm of emergency meetings had slowed. Officials gathered not to make decisions, but to document them, a form of bureaucratic inertia designed to project motion where none existed. "Every day looks the same," said one insider. "The reports, the statements, the silence, it's all part of the same ritual." By this point, even the language of crisis management had decayed. Liquidity provision became stability maintenance. Economic adjustment became strategic patience. The words repeated until they lost meaning, the verbal equivalent of static. It's semantic collapse, observed one linguist. When power cannot admit loss, it repeats itself into disappearance. On state television, the narrative reached a new level of abstraction. Anchors no longer mentioned banks or withdrawals, they spoke instead of national resilience and civilizational economy. It was not an explanation, it was a distraction, a linguistic retreat from fact. The message, explained one media analyst, is no longer that everything is fine. It's that nothing outside the message exists. And yet, despite this meticulously crafted silence, fragments of truth continued to surface. Satellite data revealed reduced nighttime illumination across several financial districts, a quiet metric of decline. Private surveys showed a steep fall in consumer activity, even as official data claimed stabilization. And in encrypted professional groups, economists began to speak in guarded metaphors. The patient breathes, one post read, but no pulse is detected. According to confidential correspondence reviewed by monitoring institutions, a small group of policy advisors had proposed an extraordinary measure, psychological reboot. It involved declaring a temporary pause of the financial system, resetting account structures under new regulations, and rewriting the statistical baseline to erase the perception of collapse. It's a software update for reality, said one foreign observer dryly. They're rebooting trust through fiction. By now, even within the halls of power, a quiet fatalism had taken hold. No one expected reversal, only endurance. We can't stop it, one official admitted privately. We can only describe it slower than it happens. The remark spread among analysts, becoming the unofficial epitaph of the crisis, the acknowledgement that the system's death would be bureaucratically documented as life. Outside, the public mood mirrored that exhaustion. There were no protests, no collective outrage, only an unspoken consensus that the financial contract had expired. People adapt faster than systems, noted one social researcher. When institutions collapse quietly, citizens learn to survive without noticing. And so, the final stage of the crisis arrived without headlines, without spectacle. The ruble still existed, accounts still opened, officials still spoke, but none of it meant anything. The country had entered what experts called structural suspension, a state where the economy continues to function physically, but conceptually, it has already ended. International analysts concluded that this collapse was unlike any before it. Not a crash, not a default, not even a revolution. It was a silent implosion of confidence, a vanishing act performed in plain sight. The banking system remained intact on paper, yet hollowed out in spirit. The real contagion, one report summarized, is not financial, it's epistemic. Once a society stops believing in its own numbers, it stops believing in its own future. By the end of the day, the final statement from the central bank was released. It contained only 7 words: liquidity secured, stability maintained, operations ongoing. No numbers, no context, just the echo of authority repeating itself into emptiness. And as screens dimmed and the nation's attention shifted elsewhere, one truth remained, whispered among analysts who had watched every signal fade: the collapse had not ended, it had simply learned to stand still.